What is trading? Today, I want to dedicate the entire video to what trading is and why there's so much buzz around it. Let's start with the fact that it's trading on financial markets. Since many assets are subject to volatility and the prices are constantly changing, the idea is to buy something at one price and sell it at another. The logic here is elementary, but let's take it one step at a time. Trading itself is the trading of valuable assets, also known as an exchange-traded financial instruments, with the goal of profiting from the differences in these prices. And trading process itself is called trading session. Sometimes these transactions take place with minutes or even seconds, so trading offers the opportunity to make a quick profit or lose investment if the price movement doesn't meet expectations. There's a price that's constantly changing. A minute ago it was one way, and now it's different. And a trader is someone who tries to profit from these price movements. As a trader, we strive to anticipate such changes, then initiate and exit short positions promptly. This is accomplished through technical analysis, which involves forecasting prices based on past price movements. Technically, analysis patterns are geometric shapes that can be plotted on a chart to help predict direction of a stock price. Technical analysis patterns are used for two main purposes: determining the best time to enter a trade and understanding when to sell a security. But before using the patterns themselves, it's important to understand support and resistance lines. These price ranges represent areas where the price has previously changed direction. Simply put, a level presents a price range within which traders consider an asset to be oversold or undervalued based on the current market situation. It's important to closely monitor key levels, especially where support and resistance roles change or strong price rebounds occurs. Now, let's go back to patterns. Let's highlight the four main patterns most often heard among traders. The first is the head and shoulders. This is a trend reversal pattern that can form a triple top or bottom. A head and shoulders consists of three consecutive rising or falling waves. The second wave is always larger than the two sideward waves. That's why the pattern is called head and shoulders. Next, there's the double top and double bottom. This is a trend reversal pattern that signals areas where the market has made two unsuccessful attempts to break through a support or a resistance level. A double top forms in a rising market, while a double bottom forms in a falling market. The next pattern is an ascending triangle, a trend continuation pattern. It forms a rising market from ascending and horizontal trend line. The horizontal trend line represents resistance, while the ascending trending represents support. The final pattern we'll look at in this video is the descending triangle. This pattern is the opposite of an ascending triangle, which forms in a falling market and reflects declining demand. The descending upper trending indicates that the likelihood of a support breakout, the actual trading process, and use of all of the above-mentioned instruments takes place on dedicated platforms. Today, there's no need to go anywhere. Everything happens online. You simply open the platform, select an asset, look at the price chart, and decide whether to buy or sell. TradingView is considered one of the most popular and convenient. This online service allows you not only to monitor the price movements in real time, also to analyze the market. What makes TradingView particularly valuable is its universality. You can work with any instrument, including currency pairs and indices. Moreover, access to the platform is completely unlimited. You can access it through a browser or a mobile app, which is very convenient because it allows you to stay up to date with developments at any time. Many choose this platform for several reasons. First, because its simplicity. The interface is designed so that even a beginner can figure out everything in a couple of hours. On the left is a panel with drawing tools, lines, levels, and Fibonacci grids. Above, you can manage the chart, select a time frame, add indicators, change the chart type, and so on. On the right, you can create your own list of monitored instruments, so you always have the currencies you need at your fingertips. Secondly, flexibility. TradingView has hundreds of built-in indicators, from simple moving averages to complex oscillators. Moreover, if you have the desire and the little patience, you can write your own indicator. This gives you freedom. You're not limited by any standard tools. You can literally assemble your own analysis system. Pretty cool, right? Getting started doesn't require much. It's all quite simple and predictable. Just visit the website, register, and you'll be immediately taken to the workspace. After registration, you'll be taken to the main page. You can also view market reviews, explore ideas from TradingView community members, and read news and learn about global trends. As a trader, I consistently monitor the market price, action, analyze, reflect, and make decisions. Some open trades for a few minutes, while others hold positions for hours, days, or even weeks. It all depends on your goals and trading style. Speaking of which, let me tell you about the types, or as I said, styles of trading. There are 4. Scalping is an ultra short-term trading style where profits are derived from minimal price movements. 10 to hundreds of trades can be made per day, holding positions for a few seconds to several minutes. Next, day trading is a style in which all positions are opened and closed within one trading day. The next type, swing trading, is an approach focused on holding positions for several days to several weeks. Swing traders aim to capture the swing of an asset's price. That is, the medium-term movement that forms within a larger trend. The final type, positional trading, is a long-term approach which positions are held for several months to several years. Positional traders focus on fundamental factors and macroeconomic trends, ignoring short-term market fluctuations. Incidentally, this type of trading, and indeed trading in general, is often confused with investing because while they may seem the same on the surface, there is a difference. An investor typically buys assets for a long term. They might buy a company's shares and hold them for years, hoping their price will rise over time. A trader, on the other hand, trades short term. They might open a trade today and close it in a couple of minutes, profiting from a small price change. Trading itself is more dynamic, fast-paced. The price, as mentioned earlier, can change in seconds, and we have to react to it right there and then. Therefore, this field often attracts people who want to see results of their actions faster. But this can also entail risk of loss. Risk in trading is likelihood that your trade will not go as planned. It's important to understand that this doesn't mean you'll definitely lose. It's simply a possibility of an undesirable outcome. Therefore, the better you understand where the risk is, or where the risk lies, the more at ease you will feel. You can trade whatever you like, because there are different markets, for examples like foreign exchange market, where we trade currency pairs, or stock market, where you buy and sell company shares. But no matter which market you choose, the essence remains the same, working with price. And if you want trading to be more manageable, you need to break it down step by step. That's why I always say that trading is a skill that doesn't develop overnight. It needs to be developed. It's really important to reiterate one simple idea. Trading is based on simply observing the price, which can rise, fall, or stand still. All a trader does is try to figure out what the price is most likely to do next. No one in the market knows for sure where the price will go, and even the most experienced traders can't guess every trade. The essence of trading isn't always being right, but rather ultimately coming out on the top over a series of trades. You make some gains, you lose others, but if you do everything right, the outcome is positive. When people are just starting out, they feel like they need to know everything: terms, indicators, strategies. This can create confusion, but the truth is, it's important to understand the logic of the process at the start. Trading is a process of trial and error. You analyze your actions, see where you went wrong, draw conclusions, and move on. Over time, you come to understand that you don't need to chase every opportunity. Sometimes the best trade is the one you didn't take. I should also point out that trading doesn't guarantee daily income. Risks are inherent. Therefore, potential profit depends on successfully forecasting market prices, and the main risks are associated with various factors that can influence asset price dynamics and disrupt traders' expectations. Furthermore, technical analysis relies solely on historic dynamics. It never takes into account current market data. Therefore, trading forecasts can be misled by current news and events. Many strategies rely on short positions, which involves margin trading. Therefore, if you misjudge the price movement of a particular asset, you could lose your money and end up in the red. Of course, there are days when the market offers opportunities, and sometimes it's better not to trade at all. Learn to approach each trade calmly, not as your last chance to make money, but as one of many steps. Guys, let's be honest. No matter how much I explain how trading works, it only really becomes clear when you see it in person. When you look at a real market, the chart, and the decisions being made right here and now. So let's skip ahead and just see how it all works in real trading. So friends, let's start trading. Let's choose an asset, the AUD NZD. We see the price is trying to break through the 50 RSI, and the green line on the alligator is almost intersecting the red line, which tells us we're about to move higher. So let's open a long trade. See, the price has already tried to break through these lows several times, but to no avail. So we'll open a long trade now, and we'll likely see a breakout. And great, we've secured our first profit. Next, let's select the CHF-JPY asset. Here, we also see that the price is trading at 50 RSI and is about to break below. The green and red lines are starting to intersect, so we open a short trade. However, this is quite risky, and if the price rebounds, we'll have to take a catch-up trade. That's exactly what's happening. The price bounced on the 50 RSI, so we're taking a catch-up trade. Great, everything's worked out. The catch-up is in. Now, let's select the EUR and the USD OTC asset. We see that the price has been trading at the 30 RSI for quite some time, so we can confidently enter a long trade. Everything is also great. It's jumped sharply upwards. This suggests we were right and we're taking our profit. We select the next asset, the USD CHF. We see the price is trading at the 70 RSI, which suggests possible reversal. What's more, it has already broken through the previous highs. We enter the upside, but there, well, as a previous trade, if the price bounces up before the correction, we take a catch-up trade. That's exactly what's happened. The price bounced up, so we take a 150 catch-up and see that after the price drops sharply, continues to fall, so we take our profit. We select another asset, the EURNZD. We see that we have lower highs and the price has already repeated, bounced off to the 50 RSI. Accordingly, we enter the trade downwards and take it out of the black. A trading journal is your personal assistant. It records decisions, emotions, and results. Without it, you rely solely on your memory. Memory can fail us at the most inappropriate moment. When you know you need to record your actions, you automatically become more disciplined. A journal helps you learn faster because you begin to see patterns, which actions are productive and which ones are constantly leading you down the wrong path. It helps to manage risks. For example, you see where you're oversizing a trade and where you are forgetting to set a safety level. And most importantly, a trader's journal gives you a sense of calm. Having a plan, keeping records, reduces your stress levels. Review your notes at least once a week. To see positive results, you'll only need to make one change for the following week, and in a couple of months, you'll be surprised how your approach will change. Summarize everything we've discussed today. It's worth emphasizing once again that trading is about working with price, probability, and your own decisions. There are no guaranteed trades, but there is logic, discipline, and an understanding of what you're doing. If you want to achieve real results in this area, you should first define your approach. That is, choose the trading style that suits you best, learn the basic terms you'll need when working with charts, and learn technical analysis, without which you'll simply start losing money. If this video helps you better understand trading and how it works, then you've achieved your goal. Thank you for watching to the end. Subscribe to the channel so you don't miss any new videos. Like it if you found it helpful, and be sure to leave a comment to support the channel and help it grow.